In the early 1990s, Asia was the future. Capital flowed eastward with evangelical certainty. Governments were praised for discipline. Growth rates dazzled economists, and currencies seemed immovable, pegged stable, disciplined by design. From Bangkok to Seoul, Jakarta to Kuala Lumpur, the story was irresistible. A new model of development had emerged, one that combined export-driven growth, state-guided finance, and global integration, without the chaos that had plagued Latin America or Eastern Europe. To investors, Asia looked not just promising, but safe. That perception would prove fatal. The Asian financial crisis did not begin with collapse. It began with confidence, too much of it held too cheaply for too long. Throughout the late 1980s and early 1990s, capital poured into Southeast Asia at an unprecedented pace. Banks borrowed in dollars and yen at low interest rates and lent domestically at higher returns. Corporations loaded balance sheets with foreign currency debt, assuming exchange rates would remain fixed forever. Governments encouraged this behavior implicitly by defending currency pegs and explicitly by signaling stability above all else. The system appeared virtuous. Capital inflows fueled investment. Investment fueled growth. Growth reinforced confidence. Confidence attracted more capital. It was a self-reinforcing loop until it wasn't. The vulnerability lay beneath the surface. Exchange rate pegs masked currency risk rather than eliminating it. Financial systems expanded faster than regulation. Short-term foreign debt financed long-term domestic projects. Banks assumed rollover would always be available. Corporations assumed refinancing would be effortless. Governments assumed reserves would deter speculation. Each assumption depended on the same fragile condition that confidence would never break. Thailand was the fault line. By the mid-1990s, Thailand's economy was overheating. Real estate prices surged. Credit expanded recklessly. The current account deficit widened. Export growth slowed as the dollar strengthened, dragging the baht with it. Competitiveness eroded quietly. Speculators noticed. They did not attack out of malice. They attacked because the numbers no longer aligned with the story. In July 1997, Thailand abandoned its defense of the baht. The currency collapsed. What followed was not a localized correction, but contagion. Investors reassessed the entire region through the same lens: high leverage, fixed exchange rates, weak banking oversight. Capital fled en masse. Currencies fell. Balance sheets imploded overnight as foreign currency debts ballooned in local terms. What had looked like solvency became insolvency in weeks. The crisis spread with merciless speed. Indonesia's rupiah collapsed. South Korea's chaebols teetered. Malaysia imposed capital controls. Hong Kong defended its peg at enormous cost. Each nation faced the same brutal arithmetic debts denominated in foreign currency revenues earned domestically confidence, evaporating faster than policy could respond. The human cost was immense. Factories closed. Unemployment surged. Middle classes built painstakingly over decades were wiped out in months. Poverty rates spiked. Political systems buckled. Indonesia's Suharto regime collapsed under the weight of economic and social unrest. What began as a financial correction became a political reckoning. International institutions stepped in, most notably the International Monetary Fund. Rescue packages were assembled conditional on austerity, structural reform, and liberalization. To some, the IMF was a firefighter. To others, an accelerant. Interest rates were raised to defend currencies' deepening recessions. Fiscal tightening cut safety nets when they were needed most. The debate over the IMF's role remains unresolved, but the resentment it generated reshaped global financial politics for decades. What made the Asian financial crisis so shocking was not merely its severity, but its reversal of narrative. Asia had been held up as a model of disciplined capitalism. Suddenly, it was portrayed as reckless, opaque, and cronyist. The truth lay between extremes. The crisis was not caused by Asian culture or corruption alone, nor by Western speculation alone. It was caused by mismatch between short-term capital and long-term development, between fixed exchange rates and open capital accounts, between confidence and capacity. The crisis revealed a brutal truth about globalization. Capital is mobile, but responsibility is not. When money floods in, it is celebrated as validation. When it leaves, it is condemned as betrayal. Yet capital behaves predictably. It chases return and flees risk. The mistake was not openness itself, but opening without buffers, without regulation, without the ability to absorb shock. For Asia, the crisis was traumatic, but formative. Countries rebuilt reserves obsessively. Exchange rate regimes became more flexible. Banks were recapitalized and regulated. Debt maturity profiles lengthened. A deep skepticism toward foreign capital took root. The scars of 1997 shaped policy responses for a generation. Standing in those markets in the late 1990s, one could feel the speed with which the invisible hand turned into a clenched fist. Growth that had taken decades to achieve vanished in quarters. Faith in technocratic management dissolved. The promise of convergence with the developed world felt suddenly fragile, and yet embedded in the wreckage were lessons that would later define resilience. Asia learned to fear sudden stops, to distrust easy money, to value reserves, flexibility, and sovereignty. These lessons would shape how the region responded to future crises, including 2008, often with greater success than the West itself. The Asian financial crisis was therefore not merely a regional meltdown. It was a warning shot for the global system. It showed what happens when financial integration outruns institutional capacity. It exposed the asymmetry between creditors and debtors, between global markets and national societies. And it forced a rethinking of how emerging economies should engage with global finance. As the dust settled, one question lingered. In every capital was the crisis, a failure of Asia, or a failure of the system that had invited it to open so quickly. The answer would not come immediately. It would emerge slowly through recovery reform and memory, as nations rebuilt not only their economies, but their relationship with global capital. A relationship forever altered by the realization that stability in a world of mobile money is never granted, only borrowed, and always conditional on trust that can vanish without warning. A realization that would shape policy politics and financial behavior long after currencies stabilized and growth returned. A realization that marked the end of Asia's innocence in global finance and the beginning of a more guarded strategic engagement with the forces that had once seemed so benevolent an engagement that would only deepen as the world moved toward new crises, new cycles, and new tests of resilience, tests that would reveal whether the lessons of 1997 had truly been learned or merely endured tests whose outcomes would reveal themselves not as a simple recovery, but as a permanent shift in how Asia, and eventually the world, understood financial power, vulnerability, and sovereignty. For the true legacy of the Asian financial crisis did not lie in how quickly growth returned, but in how profoundly behavior changed afterward. In the years following 1997, Asia rebuilt with a discipline born of trauma. Countries that had once welcomed foreign capital unquestioningly now treated it with suspicion. Foreign exchange reserves became a shield, not an afterthought. Balance sheets were de-dollarized. Short-term debt was lengthened. Banking systems were consolidated, regulated, and recapitalized. Exchange rates were allowed to breathe. What had once been symbols of weakness, capital controls, reserve hoarding policy. Caution became marks of prudence. This shift was not ideological, it was experiential. Policymakers had watched decades of development erased by weeks of capital flight. They had seen how quickly praise turned into blame, and how conditional support could deepen pain. From that moment on, stability became a national security objective. Economic policy was no longer just about growth. It was about survival in a volatile global system. Perhaps the most enduring consequence of the crisis was psychological. The myth of benign globalization died in 1997. Asian leaders learned that open capital markets did not guarantee fair outcomes, and that credibility in the eyes of markets was fragile and reversible. This realization planted the seeds of a more multipolar financial world. Regional cooperation strengthened. Swap lines were created. The Chiang Mai Initiative emerged as a direct response to IMF dependence. Asia quietly began building its own financial defenses. When the global financial crisis erupted in 2008, the contrast was striking. The epicenter was no longer Bangkok or Jakarta, it was New York and London. Asian economies armed with reserves and wary regulation weathered the storm far better than expected. The student had learned from the lesson while the teacher had forgotten it. History once again had reversed roles. The crisis also reshaped how economists thought about development. The assumption that capital account liberalization was an unambiguous good was abandoned. Sequencing mattered. Institutions mattered. Mismatches mattered. The idea that emerging markets should open first and regulate later lost credibility. Financial stability returned to the center of development strategy, where it had always belonged. And yet the Asian financial crisis did not end the cycle, it merely reset it. Capital flows returned. Growth resumed. Inequality reemerged. New vulnerabilities formed. Memory fades faster than balance sheets. Each generation must relearn caution because the incentives of global finance reward forgetting. The final lesson of 1997 is therefore not about Asia alone. It is about the nature of modern finance itself. In a world of mobile capital and fixed political boundaries, crises are not accidents. They are corrections. They expose where promises outrun capacity, where confidence substitutes for resilience, where growth is financed by fragility. If this journey through the Asian financial crisis changed how you see capital flows, exchange rates, or miracle growth stories, share what stayed with you. And if you want to continue exploring how financial crises reshape nations, long after markets stabilize, follow the channel and stay with this story. Because the most important effects of a crisis are never visible at the bottom of the chart, but in the choices societies make once the panic ends.